All right, thank you all for tuning in today. My name is Jeff Badu, and today we'll be hosting Finding Money Friday. So basically, it's a 5-minute segment, very short. And today I'm here with a close friend of mine, Mr. Antonio Lugo. Antonio is the president of Smart Wealth Strategies, and which also is with Brookstone Capital Management, which is an SEC registered investment advisor. He holds a Master's of Business Administration with Loyola University Chicago, and he's an adjunct faculty member of North Park University. He holds a certification with National Social Security Association, and he's been a featured guest speaker with the following media partners: WGN, Fox News, and WCIU. And so now I'll really turn it to Mr. Antonio to give a quick, basically get into the presentation, and I'll be turning it on to him.
Conference. You will now be placed into the conference. This call is being recorded.
All right. Jeff, can you hear me?
Yes, sir.
All right. Well, thank you for having me today. And I'm looking forward to having this exchange. Again, 5-minute Finding Money Fridays. I'm excited to be partnering with you, and thank you for inviting me. So before I get started, let me go ahead and remove my screen here. All right, now we're moving on our screen. Thanks for being patient. All right, so let's take a look at my presentation today. Now, as part of our session here, my job today is really to help save people money. And the way I call it is really being more efficient with our money and how we can be able to see clear on how we can help reach our financial goals, but yet do it in a more efficient manner. So oftentimes we hear many things out there that we believe to be true. Now, the decisions you all have to make is when someone comes in with new ideas and new information, you can either choose to ignore that information, or if I often ask people, is you get a bigger box. And that's kind of what I want us to head into, because like anything else, if we don't open our eyes, open our possibilities, then we really won't know how we can improve our situation. So when I sit down with clients, and I've been doing this for close to 20 years now, I want to make it more of a visual conversation, because it really makes you, as an investor, as a saver, as a spender, help you understand how money flows. And I call this the personal economic model. This particular visual allows people to see how money flows in and out of your hands, or out of your control. Now, as you can see here, most of us have earned income. We work, and I'll put a little draw. Where's my little, oops. So as you see how money flows into our tanks, unless there's inheritance or through Social Security, most often money is earned through wages. And the natural flows come in through your cash flow. But look at the first partner that takes part of your income or your check, which is the tax filter. And that's really what our conversation is going to be about, is understanding how the tax filter impacts our cash flow. But the natural flow, if you see here, is to go pay for the current lifestyle, and the drawing here, and show you that most of us would expect the flow to go out to here and pay for our cars, for our lifestyles, food, housing, and entertainment, and other large expenses. So that's really the natural flow of money. What most of our conversations would be right here in the tax area. But this lifestyle regulator is really important, because depending on how you choose to live and where you choose to spend your money, it really could be high at sometimes, could be expensive, but that's a lifestyle choice most of us will have. These two particular tanks are really interesting, because these are what we call our savings tanks. They can be at risk, or they can be in safe tanks. The bottom line is, at some point, these will be part of our future. I will make a comment, though, because most of us use retirement accounts, we call them IRAs or 401ks. Well, they never pass through the tax filter. They tend to bypass the filter and go straight right to the investment tank. But at some point, these two tanks, if they're not full enough, and we're expecting to count on them as part of our lifestyle in the future, because these release valves will be part of that lifestyle that we want to protect. So I want you to understand that that's how the flow of money works. But let me go right into the conversation I want to have with you today, Jeff. Tell you now, this is a great time to talk about taxes. Did you have a good year on the tax season?
Yeah, it was a pretty good year. It was very, very rough, but ultimately got through it and was able to save some clients some money.
Right, and let me ask you this, because most of us go to our tax preparer and make sure that obviously we're following the tax laws and we do what we're supposed to be doing. Do you often see our clients or your clients have accounts that tend to be in taxable accounts? What are taxable accounts? Could you help us with that?
Yeah, so taxable accounts are things like CDs, mutual funds, it's just a bunch of different stocks and things like that. All these are taxable accounts. So you always want to watch out for them and make sure that you understand the taxes behind it.
And what's that lovely letter they often send to you every year to let you know that you've got money in a taxable account?
Basically, it's typically a 1099 that's sent out to the client. So it basically reports, let's say, interest, dividends, and just different things like that.
Right. So let's use an example. Let's say it could be $1,000, $100,000, but I'm going to use the round number of 100,000. Keep it easy. Let's say I have $100,000 in let's use the bank account. Let's call it a money market. Exactly. And that particular year, I'm going to expect to earn 5%. So as this account, let's just use the first year, it earned 5%, which is equivalent to $5,000. Mm-hmm. Well, this sounds pretty good. I'm happy with the rate of return. So over the years, as you see year after year, this account keeps getting bigger and bigger and bigger. 13th year, 14th year. Let's take it all the way down to 20, and now we're past all the way to 30 years. Now, after 30 years, this is the magic of compounding, right, Jeff?
Yes, sir.
5%, never lost money. I'd be pretty happy.
The most powerful force in the world.
Absolutely. And those gains remain in that account, and they kind of triple, and hopefully it builds some quite a bit of wealth. Now, we're pretty happy when we get these type of returns and accumulate that much. But I will ask you something. Isn't it oftentimes as this compounding miracle occurs, if we have the government involved in our taxes and involved in this account just as much as we are, we call this our silent partner. Well, they take no risk, and they participate in all the profits. So as this compounding interest in this taxable account occurs, the taxes also increase along the way with the growth of that account, wouldn't it, Jeff?
Yes, sir. So
let's take a look what kind of impact are we talking about? Well, as you can see, if I took that first year account and, well, I made that $5,000 on my $100,000, that's great. But also the tax cost or the tax loss, let's use a 20% rate. It cost me $1,000 that particular year. Well, what do you think about that?
I mean, I personally don't like it because I don't like ever writing a check to the government personally.
Mm-hmm, mm-hmm. Right, but this is where we've chosen to put our monies, and this is the result of that. But let's take a look in 10 years. We might see it's a small check, but as over the years, it's only an annual payment of, now it's gone from $1,000 to $1,551. But cumulatively, the last 10 years, I've paid almost over $12,000 in taxes, despite having my account to go to 162. But I don't really notice that until if I put more years behind this and I let this sit all the way to that 30th year where I really get excited. That 432 also had a tax loss of $66,000, over $66,000. That can be pretty impactful.
Yeah, I mean $66,000. That's a lot. That could be a down payment on an investment property or something.
So would you say that the tax is the IRS or the government is also benefiting just as much as I'm benefiting?
Oh yeah,
absolutely.
I think so.
But there's another critical point I want to share with you though. Have you ever heard of loss or the opportunity cost? This area in purple that I'm describing here.
Oh yes.
Now, I like to share an example, and then maybe you'll agree or not, but because of tax season, wouldn't you agree that most of us would have expected a refund? That would have been making us happy as well, right?
Yeah, I would say for the most part, people are pretty happy when they see a tax refund.
But where did the refund come from? How did that happen?
It came from them overpaying, basically from them overpaying throughout the year, ultimately.
To the government, basically.
Exactly.
So the withholdings that they've made, on like the tax filter example, has accumulated so much that I've overpaid in taxes.
Exactly.
So since I've overpaid, they're going to give me the exact difference of what I was expected to pay and what I actually did pay.
Exactly.
Now, do they pay me interest for that money, that extra?
Not a dime.
Not a dime. So they gave me the exact amount of what I owe, basically. So would you say that was an actual overpayment that they took, they probably put in their account?
Oh, yeah. They might have made 20% on your money.
So I lost money because I got no interest on that money.
Exactly.
So it's an interest-free loan to the government.
Exactly.
All right. Well, so that's a lost opportunity because I had that money in my pocket, I may have put it in the 5% account.
Exactly.
So this is an example of the lost opportunity cost that I like to share with you. So if I click this button here, if I include that first year, that $50 opportunity cost, that $1,000 I didn't have to pay that first year. Well, that would have created an extra $50 in my pocket because I would have lost that in a tax loss. And after 10 years, that opportunity cost would have cost me in an annual basis $665, but cumulatively I've lost almost $3,000 in opportunity costs had I had that money in my pocket. So I think it's not just the increasing tax liability, but the opportunity of what that money would have earned for me had I kept it in my pocket and not give it to in this example that we share, not give it to Uncle Sam. Exactly. Now, I'm a responsible taxpayer, by the way, and I have no problem paying my taxes, but I also want to make sure when it's unnecessary tax losses, that's when I ask for my tax advisor, maybe my financial advisor, somebody advise me I might be doing something inefficient. And that's part of our conversation today. So I think despite all that, I think we did a good job. Is there any other questions?
Yeah, I mean, I think it was pretty solid, pretty clear. Definitely a good start. Something that people should definitely think about when making investment decisions and things like that. Because I mean, we could even just stop at the taxes on the interest, but when you add in opportunity costs, that's an extra layer that you definitely should be thinking about.
Great. Another great segment of just trying to save people money. I hope everybody has a great holiday weekend.
Yeah. Yes, sir. Thank you, Antonio, and I hope you all enjoy the rest of your weekend. We'll be continuing this each and every single Friday. It's called Finding Money Fridays, and I hope you all have a great rest of the weekend. Thank you.